Good morning, everyone. The Monetary Policy Committee met yesterday, June the 10th, and decided to lower the central bank rate, the CBR, by 25 basis points to 9.75% from 10%. The Monetary Policy Committee observed that overall inflation was expected to remain below the midpoint of the 5 plus minus 2.5% target range in the near term, supported by stability in food and energy prices and continued exchange rate stability. The central banks in the major economies have continued to lower their interest rates, but at a more cautious pace depending on inflation and economic growth expectations. The average lending rates in the domestic market have continued to decline, while private sector credit growth has recovered modestly. Therefore, there was scope for a further easing of the monetary policy stance to augment the previous policy actions aimed at stimulating lending by banks to the private sector and supporting economic activity while ensuring inflationary expectations remained firmly anchored and the exchange rate remained stable. The MPC will closely monitor the impact of this policy decision as well as developments in the global and domestic economy and stands ready to take further action as necessary in line with its mandate. The committee will meet again in August of 2025. In reaching that decision, the committee looked at both the global as well as local economic developments. On the global front, the outlook for global headline inflation is a deceleration of inflation from 5.7% in 2024 to 4.3% and then to 3.6%. This is it's an increase in inflation compared to the projections that were there before the increase in tariffs. Previously, the expectation was that inflation in 2025 would be 4.2% and would be 3.5% in 2026. And as a result of these higher inflation rates, the central banks in major economies have adopted a more cautious approach in lowering their policy rates. With regard to oil prices, these are expected to moderate, reflecting an increase in supply both from the OPEC Plus and also the non-OPEC Plus producers, but also muted demand in some of the major economies, such as China. The main risks to oil prices relate to trade tensions, which could affect global energy demand and supply disruptions from the ongoing conflict in the Middle East. With regard to food inflation, this has eased slightly in May 2025, from 7.9% to 6%, largely reflecting the lower inflation for cereals prices and reflecting lower maize and also wheat prices based on increased production for maize in Argentina and Brazil, and also in the US. In terms of our major trading partners, the US, the UK, the Eurozone, and China, the headline inflation has continued to trend downwards, largely reflecting lower energy prices. However, core inflation, as shown in the right-hand panel, remains elevated and sticky, and therefore reducing the policy space for further interest rate reductions. With regard to the global economic outlook, the overall global growth is now estimated at 2.8% for 2025 and 3% in 2026. But these have been revised downward, again, because of the reflecting the high tariffs on the by the U.S. and also the retaliatory tariff increases from previously 3.3% in 2025 and also 3.3% in 2026. The major impact on the reduction in the global growth comes from the United States, whose growth has been revised downwards significantly from 2.7% this year to 1.8%, and again from 2.1% in 2026 to only 1.7%. Our other trading partners have been affected. The UK growth has been revised downward by 0.5% in 2025 and 0.1% in 2026. Similarly, for the euro area, the growth has been cut by 0.2% this year and a further 0.2% next year. Important to note is the growth for Kenya, which also has been reduced by 0.2%. That's the very bottom line, and a further reduction of 0.1% in 2026. Nonetheless, the growth for Kenya exceeds the average for the sub-Saharan Africa, which is 3.8 in 2025. And Kenya's growth in 2026 is 4.9 compared to the sub-Saharan Africa of 4.2. And of course, as I said, the average for Kenya exceeds the global average of 2.8 and 3% in 2025 and 2026 respectively. With regard to financial markets, the recent developments in the U.S. financial markets did result in a notable increase in spreads for emerging and frontier market economies. And of course, these developments have implications for access to international capital markets by emerging as well as developing market economies, and of course also for Kenya. So just to summarize, global headline inflation is projected to decline, but at a slower pace because of the expected inflationary impact of higher tariffs on trade. And the central banks in major economies have adopted a more cautious approach in lowering their policy rates. Global growth outlook for 2025 has been revised downwards, mainly on account of the higher tariffs, heightened uncertainty, weak global demand, and elevated geopolitical risk. The global financial conditions have been volatile, mainly reflecting elevated trade policy uncertainties, the weak global growth due to trade policy uncertainties. That Kenya's real GDP growth is expected to remain above the global, the sub-Saharan Africa, and emerging market and developing economies averages in 2025 as well as in 2026. Turning to the domestic macroeconomic developments and outlook, inflation is expected or did decline to 3.8% in May from 4.1% the previous month of April. And the reason for this decline was a fairly significant decline in non-core inflation from 8.4% to 6%, and that more than offset the increase in core inflation from 2.5 to 2.8%. In terms of contribution to overall inflation in May, the 3.8% inflation, 1 percentage point comes from the non-core inflation, and the 2.8 percentage points come from core inflation. The main drivers of non-core inflation and the reason for the reduction in core inflation was due to lower inflation for food crops and related items, particularly vegetables. There was also the decline in energy prices, which was driven by electricity prices, but there was also a decline in transport inflation. Indeed, for all three categories of non-core inflation, there was a deceleration in inflation. With regard to the main drivers of core inflation from the 2.5 to 2.8%, this was on account of higher prices of processed food items, particularly maize flour and sugar. Looking forward in terms of inflationary expectations and projections, the May 2025 Agricultural Sector Survey and the CBK projections show that inflation expectations remain anchored within the target range in the near term. Indeed, of those sampled in the agricultural sector, 57% believe that inflation within the next 3 months will either decline or remain unchanged, and only 43% believe that within the next 3 months that inflation will increase. And the reason for this optimism about inflation is on account of the expected stability in food prices because of the favorable weather conditions, but also because of stability in pump prices and the continuing stability of the exchange rate. So in terms of forecasts up to May of 2026, we expect inflation to remain around the midpoint of our target range, and that is about 5%. Turning to the domestic economic growth, and looking at the very last row at the bottom, the real GDP growth decelerated to 4.7% in 2024 from 5.7% the previous year. This year we expect a recovery to 5.2% and a further recovery to 5.4%. The decline in 2024 was mainly on account of the construction sector, which contracted by -0.7%, but also the services sector did not do as well as in the previous year, partly also because interest rates happen to be higher than, happen to be higher. So for 2025, we expect a turnaround in the construction sector, and indeed we expect construction to increase by about 4%, and the services sector to perform about the same level as last year, and similarly for agriculture to perform relatively at a level unchanged from last year of 4.8% growth compared to 4.6%. And the reason why we expect construction to perform relatively well, and it's important to note first that it's been a very, very long time since a value addition in the construction sector contracted. And there are several reasons for that, but in 2025, we now expect that especially with the reduction in pending bills in the roads sector, that some of the contractors have already been paid and they've gone back to work. So we expect that to generate additional value addition in the construction sector. We expect under the new budget by the National Treasury that there will be additional expenditures by the government. And then finally, the lower interest rates in 2025 from the banks, we expect that to also have a positive impact on construction by the private sector. We have also taken into account in 2025 the higher tariff increases by our trading partners, and this has moderated the projected growth. Without those tariffs, we had expected that the economy can grow by 5.4% this year, and a further 5.6% in 2026. Part of the reason for the optimism in the turnaround of the growth is the performance of credit to the private sector. As you can see, in the manufacturing sector, we see a turnaround from minus 14.3% in September of 2024. And this has slowly increased, credit has increased to a point where it has now become positive in May, a positive of 1%. But it's still small, but it is in the right direction. Similarly, for trade, transport and communication, and the consumer durables, we do see a turnaround in bank credit to those particular sectors. The May 2025 surveys, we took surveys of the CEOs and also the market perception surveys, and these surveys reveal sustained optimism about domestic business activity and economic growth for the next 12 months. Specifically, with regards to the banks, in May, of those who were polled, 3% were very optimistic about growth prospects in the next 12 months, and 91% were optimistic about growth in the next 12 months. So that is a total of 94% of those polled in the banking sector were either very optimistic or optimistic about growth prospects. For the non-bank private sector, again, the combination of those who are very optimistic and those who are optimistic was roughly 75%, and only 3% were very pessimistic about growth prospects in the coming 12 months. When we surveyed the CEOs of companies for the May survey, 36% thought that growth will be higher in the next 12 months, and this is compared to 28% the previous month. And of course, there was also a reduction in those who thought it will remain the same. So generally, there is optimism from the CEOs and also the banking sector and the non-bank sector. And this optimism is attributed to the stable macroeconomic environment supported by low inflation and a stable exchange rate, and improved agricultural production supported by favorable weather conditions and the continued decline in bank interest rates. Some respondents expressed concerns about subdued consumer demand, high cost of doing business, and increased global uncertainties, again attributed to the geopolitical and trade tensions. So again, to summarize on the domestic economic growth, the performance of the Kenyan economy slowed down in 2024, with real GDP growing by 4.7 compared to 5.7 the previous year, mainly reflecting deceleration in growth in most of the sectors of the economy. However, leading indicators of economic activity point to improved performance in the first quarter of 2025. The projected growth of the economy in 2025 has been revised downwards to 5.2% from 5.4% on account of the higher tariffs on trade. But the resilience of the key service sectors and agriculture, expected recovery in the growth of credit to the private sector, and improved exports are expected to support the pickup of growth in 2025 and 2026. The MPC surveys conducted in May 2025 revealed sustained optimism about business activity and economic growth prospects for the next 12 months. The growth outlook is subject to external and domestic risks, including higher tariffs and persistent geopolitical conflicts with potential impact on supply chains. Turning to monetary developments, the new monetary policy framework has enhanced the stability of the interbank rate and has aligned the interbank rate to the CBR. And you can see that by comparing where we were in the early part of 2023, when there wasn't much of a relationship between the central bank rate and the interbank rate, which is the pink line. On the other hand, if you look towards the end of June 2025, you can see there is a convergence between the interbank weighted average rate and the central bank and the CBR rate. So, and using that monetary policy framework, which is about inflation targeting, the easing of monetary policy since around August of 2024 has resulted in short-term interest rates declining from between 16 and 17% to 8 and 10%. The 10% is for the 364-day Treasury bills, and the 8.5 is for the 182-day Treasury bills, and the rate for the 91-day Treasury bills is here shown as 8.3. In the last auction, these rates also again declined, for the 364 to below 10%, and there was also a slight decline in both the 182-day and also the 91-day T-bills. So commercial bank lending rates have continued to decline gradually, partly reflecting the reduction in those short-term rates that I just mentioned. And we have seen the average lending rate decline from 17.2% in November of 2024 to 15.4% in May of 2025. With the reduction in those rates, and also with the easing of monetary policy by the central bank, the growth in there's been a recovery in broad money growth from minus 1.4% earlier this year. We have seen the M3 money supply continue to grow every month, and by the end of May, we see an increase in broad money supply of 8.2%. And similarly, for the credit to the private sector, reached a low of minus 2.9 around January of 2025, and we have seen a steady improvement, and as at May, had reached a positive 2%. So to summarize on monetary developments, the growth in money supply has improved further in April and May, partly reflecting increased lending, net lending to the government, improved lending to the private sector, and diminishing impact of exchange rate valuation effects on the private sector credit. Growth in lending to private sector increased in May 2025, partly reflecting increased credit demand and the dissipation of exchange rate valuation effects on the foreign currency denominated loans. The short-term interest rates have declined in line with the reductions in the central bank rate. And finally, commercial banks' average lending interest rates declined further in April and May 2025, with a continued decline in short-term rates expected to transmit further into lower lending rates and improve lending to the private sector. Turning now to the balance of payments. The balance of payments is projected to be in surplus both in 2025 and in 2026, mainly reflecting expected improvement in improved surplus in the financial account. For 2024 and also 2025, the current account deficit is for 2024 was minus $1.551 billion, and that was fully financed by the inflow of financial and capital account, which was $1.778 billion. And you can see there at the 4 lines from the bottom, the overall balance of payments. We see a very large surplus in 2024 of $1.459 billion, and that helped us to build our level of international reserves in 2024. For 2025, again, we have a still current account deficit of $2 billion, but we also have and expect financial inflows of roughly $2.55 billion, and therefore expect the overall balance of payments of about $1 billion. Regarding the current account deficit, this has narrowed over the last few years from minus 4.2% to 1.3% in 2024. For the 12 months to April of this year, compared to the 12 months to April of last year, there is a narrowing of the deficit from minus 2.2% to minus 1.8%. For the year as a whole, we expect the current account to stabilize around the minus 1.5%. The goods exports increased by 3.8% in the 12 months to April compared to last year, and this was due to higher domestic exports, particularly horticulture and coffee. And for the year as a whole, we expect an increase in exports of around 5.1%. Just to disaggregate the growth of exports in the first 4 months of this year, domestic exports actually increased by 11% in the first 4 months of 2025. However, re-exports were lower by 23.3% in the period due to lower imports of jet fuel in terms of quantities, but also in terms of prices. And therefore, the overall result was for total exports to actually decline by around 11%. But the important point here to note is the significant performance of domestic exports increasing by 11%. The goods imports for the 12 months to April have increased by 7.6%. This is almost the same growth rate as in 2024, And for 2025, we do expect imports to increase by 5.1%. Turning to the services sector, we expect services receipts to actually services receipts had increased by 12% in the 12 months to April, and we are expecting a slowdown whereby the total services receipts, and that includes transport receipts as well as tourism receipts, grow by 4% in 2025. The tourist arrivals remained strong, growing by 7.6% in the 12 months to April of 2025 on account of recovery of international travel. In regard to diaspora remittances, after growing by 18%, we projected fairly conservatively an increase of 4.5%. Already for the 12 months to April, the increase is still 12%. However, for January to April, we have seen a slowdown to 3.2%, and on that basis, we have reduced or made a fairly cautious projection of remittances to grow by only 4.5% this year. Our foreign exchange reserves are at their highest levels now and continue to provide an adequate cover and buffer against short-term shocks. We now have the gross usable reserves have reached a level of 10.8 billion, and this is equivalent to 4.75 months of import cover. The Kenya shilling dollar exchange rate has remained stable, and this has been supported by diversified foreign exchange inflows from remittances, offshore banks, and tea, as well as coffee, and also from improved confidence in the economy, and also following the prudent monetary policy that we have been following. This is just a comparison of developments in the exchange rate for major African currencies. On the left is the Ghanaian cedi, which has appreciated significantly by 30% this year. And on the other end is the Ethiopian and the Tanzanian shilling, which have weakened somewhat during the year. So to summarize on the balance of payments, developments, and outlook, the current account deficit has narrowed to 1.8% of GDP in the 12 months to April 2025. And this was compared to 2.2% in the same period last year. And this mainly reflects resilient goods exports as well as diaspora remittances. The current account deficit is expected to remain relatively stable at 1.5% of GDP compared to the 1.3% of GDP in 2024. And this reflects continued growth in exports, resilient remittance inflows, increased goods and imports, and stable global oil prices. The current account deficit is expected to be more than fully financed by financial flows, resulting in overall balance of payment surpluses of at least 1.1 billion in 2026. And this is expected to result in reserve build-up, with gross reserves projected at 11.2 billion in 2025 compared to 10 billion in 2024. And the main external sector risks relate to trade tensions arising from policies attributed to the new U.S. administration, as well as regional geopolitical tensions, intensification of geopolitical conflicts and uncertainty and volatility in the international oil markets. On fiscal performance, the fiscal deficit is expected to continue to reduce. We have here the deficit under the supplementary budget that was submitted to Parliament at 5.1%, and the budget that was submitted to Parliament at the end of April with a deficit of 4.5% in the fiscal year 25-26. But clearly, you can see there the fiscal consolidation beginning in 2020-2021 when the deficit was 8.3%, and this has been reduced all the way to 5.3% in the last financial year of 23-24. But over the medium term, by 2028-2029, we do expect the deficit to be below 3% of GDP. With regards to the banking sector developments, the banking sector remains stable and resilient. The total capital adequacy ratio stood at 20.3% in April 2025 compared to 21.1% in February. While the average liquidity ratio stood at 57.9% in April of 2025 compared to 58.3% in February and 55.8% in December of 2024. The capital adequacy and liquidity ratios were above the minimum statutory limits of 14.5% and 20% respectively. The gross non-performing loans to gross loans ratio stood at 17.6% in April of this year compared to 17.2% in February. Banks have continued to make adequate provisions for the NPLs, and the sector remains profitable, providing sufficient buffers. The increased minimum core capital requirements for commercial banks was raised from 1 billion to 10 billion by 2029, and this should lead to stronger and more resilient banks with lower costs. The lifting of the moratorium on licensing of commercial banks in April of 2025 will spur the entry of new large players to further increase the competitiveness of the Kenyan banking sector. The CBK continues to engage the banking sector on the review of the risk-based credit pricing model with the objective of making lending rates more responsive to monetary policy decisions. So to summarize the key takeaways, the global inflation is expected to decline, but at a slower pace in 2025 than previously anticipated, while the outlook for global growth has been revised downwards, reflecting elevated risks attributed to higher tariffs on trade and the persistent geopolitical tensions. On the domestic front, overall inflation remains anchored within the target range. The Kenya shilling has remained stable. Interest rates have continued to decline, which should support continued recovery in credit to the private sector and improved economic growth prospects. And with stability in prices and the exchange rate, the central bank has continued to support the government's economic growth objectives, as reflected in the further lowering of the central bank rate. Thank you very much.
Thank you. That was the Governor of the Central Bank, who was also the chair of the Monetary Policy Committee. And so, as usual, we will take your questions. There's quite a number of them that have come, but just to realize that a lot of them sort of asking around the same issues. So I'll begin with George Obulutsa from Reuters, who's asking what update, if any, are you able to give on Kenya's new lending program with the IMF that is at present under discussion? There's a whole set of that has come through as well. So anyone who's asked about the program with the IMF will be bunched together in that. There's one I thought that is quite interesting, and maybe the governor can take a stab at it, although in the presentation he did answer it somewhat, which is Winnie, who's asking